Good day and welcome to the Q1 FY2024 earnings call of MPS Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Arora, Chairman and CEO. Thank you, and over to you, sir.
Thank you. Hello from Melbourne, Australia, and welcome to our Q1 FY24 earnings call. Today on the call, I have with me Sumit Malhotra, CFO of MPS Limited, who joins us from Noida, India. Sukhwant Singh, Chief Operating Officer of our e-learning and content operations in India at MPS Limited, who also joins us from Noida. Rajesh Jamani, Chief Revenue Officer of our e-learning practice, who is currently visiting India and joins us from Mumbai. Today, Sumit will kick things off in our opening segment by discussing our financial performance. Then Sukhwant will update us on the continued momentum in our content solutions business. Rajesh will then discuss our growth in the e-learning business. Finally, I will provide an update on progress regarding the platform business, AIML progress, acquisitions, capital allocation, and also an update on the QIP process. Let's get going. Over to you, Sumit.
Thanks, Rahul. MPS delivered robust growth in Q1 FY24, well ahead of the previous year. Revenue grew to INR 133 crores on an FX-adjusted basis, and EPS was at INR 17.84 per share, reflecting 16.61% and 47.8% growth respectively. With underlying organic growth in the business preceding the planned acquisitions, the expectation now is that the acquisitions can genuinely be accretive to business performance. Reflecting on Q1 FY24, here are top 3 favorite themes. All business segments and lines of business are performing. We have returned to our roots as a high-margin business. Our top 15 customers now contribute toward 56% of our revenue, a much lower customer concentration than we started this journey in 2012. I want to hand it over now to Sukhwant to discuss content solution performance in Q1 FY24.
Thank you, Sumit. So revenue in the content solutions business grew at almost 10% in Q1 of FY24 compared to last year. Given the significant operating leverage in the business, our PBT grew faster at around 28% in Q1 of FY24 compared to the same period in the previous year. The emphasis on star accounts was a core lever that was unlocked to drive growth in Q1 of FY24. 7 of our top 10 accounts in the content solution business grew at double digits. Unlike FY23, where most of the growth in this segment was driven by the scholarly business unit, which are primarily our journals and scholarly books business units, the growth in Q1 of FY24 was more balanced, as the revenue in the scholarly business units grew at around 15% in Q1 of FY24. The educational business units have started to find their way back with around 11.5% growth in Q1 of FY24. Also, the smaller business units like digital solution saw a decent margin expansion. I want to hand it over now to Rajesh to discuss the e-learning solution performance in Q1 of FY24. Over to you, Rajesh.
Thank you, Sukhwant. E-learning continued as the second largest business segment. Revenues were at INR 32.35 crores in Q1 of FY24, amounting to 25% of our total revenue. Our e-learning business is also the fastest growing business segment, and revenue grew by 31% in Q1 of FY24 compared to the same period in the previous year. We also added 2 new customer logos to our top 10 accounts. The e-learning operations in Europe are doing much better than expected. TopSim revenue grew by 26.4% in Q1 of FY24. MPS Europa is now completely recovered. Revenue grew by 23.6% in Q1 of FY24 compared to the same period last year, and we went from a loss-making position the previous year to a PBT margin of 28.4% in Q1 of FY24. The acquisition of EI Design confirmed the validity of a new acquisition playbook, wherein we acquire growing assets at compelling valuations. In addition to substantial financial indicators, including significant margin improvement, operational indicators also showed highly positive results. We are now market leading in service delivery and quality in the e-learning practice, reflected in the high CSAT scores across our portfolio. Growth operations in the e-learning practice have matured and now are setting the benchmark for the other business units. The continued advancement of Magenu, our experience center and marketing communication business, has been highly successful with new project wins and growth in existing projects. My team and I are committing to scaling Magenu to a sizable fourth business segment for marketing communications by FY25. Back to you, Rahul.
Thanks, team. I'll start with an update on the platform business before giving other updates. Revenue in the platform business grew in double digits for the first time since the acquisition of Highwire back in 2020. Since the operating leverage is the maximum in the platform business, PBT grew even faster at over 58% in Q1 of FY24 compared to last year. The execution of product roadmaps proceeded on schedule for the entire platform suite in Q1 of FY24. The marketplace has well received the new features and functionalities, presenting numerous monetization opportunities from implementation projects and migration programs. To further enhance our offerings, we have 3 product launches planned in this business segment, one each quarter through the rest of the financial year. And we are hopeful that these will create new revenue streams for us in the long term. Our engagement in the platform business with our core customers has significantly improved, with various discussions underway on cross-selling. We also have a robust pipeline of RFPs in the platform business with new customers for the very first time in a long time. Overall, the platform business is gradually progressing from a consolidation phase to a growth phase. To conclude my remarks in the platform business, I would like to highlight first that our mission has now transitioned from being a support delivery organization to being a product development and innovation organization. This includes new product launches, active product roadmaps, and upgrades. Second, our new customer acquisition strategy that involves product service bundling and price warriorship is gaining traction in the platform business and helping us develop a new customer base. And finally, the feedback from the industry and the scholarly community is highly encouraging. Highwire and MPS now stands as the only serious independent choice since 2 of our larger competitors have been acquired by publishers. Now let's shift the focus to our progress on AI/ML, acquisitions, capital allocation, and the QIP process. The advances in AI/ML have a proportionate impact on the entire ecosystem, affecting our customers, competitors, industry, and the macroeconomic environment alike. There is no unique risk to MPS on its own. Instead of perceiving AI/ML as a threat, we view it as an opportunity to once again differentiate ourselves in a fragmented market which is ripe for consolidation. To spearhead this transformation, we have launched a new initiative called MPS Labs, a pioneering initiative headquartered in Bangalore, consisting of a team of over 100 professionals with relevant expertise. Our progress here can be classified into 3 categories: established, emerging, and pilot initiatives. MPS Labs has played a pivotal role in scaling up AI/ML application in content profiling, workflow routing, and the composition of standard layout products. Our teams are running pilots in collaboration with our customers, leveraging AI/ML in the creation of all text, content development for abstracts, summaries, assessments, and learning objectives, as well as for image creation and image forensics. Interestingly, some of these pilots have now transitioned to emerging trends, including content structuring, content tagging, automated language assessment, and also a cognitive quality model, which is first of its kind in the industry. With MPS Labs as our innovation hub, we are driven to continuously push the boundaries of AI/ML capabilities, ultimately enhancing our offerings and cementing our leadership position in the market. Moving on to acquisition, QIP, and capital allocation. We are now pursuing acquisitions of healthy companies, about at least 15% EBITDA, that are growing at least 10% over a 3-year period. The qualifying criteria for us now as a potential buyer for these type of assets has become even more important, and the deal sizes are also increasing. In this context, we have taken the conservative approach and armed ourselves with an enabling approval for the QIP. The approval was never meant to imply a definitive raise, and perhaps we could have been better in our communication. At this point, we are actively pursuing a couple of acquisitions that will be funded from internal accruals. We intend to utilize a QIP as an instrument of last resort only when pursuing a relatively higher deal size that cannot be funded from internal accruals and debt. As I've shared previously, we are comfortable raising debt in the range of 100 to 130 crores. While I don't think it's appropriate for me to comment on the likelihood of a QIP, I can confirm that based on the current visibility, internal accruals will be the first lever for us to unlock the next couple of acquisitions. Debt would be the next. And finally, if additional funds are required to pursue a large deal, then a QIP would be a last option, a last resort. On capital allocation, our priority has always been to redistribute surplus funds to the shareholders or MPS, provided there is no imminent use for those funds over the next 6 to 12 months. This approach allows us to stay focused, disciplined, and responsible, and we will continue the same policy. Let us now open the call to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask a question may press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is on the line of Namit Arora from InGrowth Capital. Please go ahead.
Thank you for the opportunity and thank you for the very helpful opening remarks. I had 2 questions. One was around the theme of supercharging scale. Now, I am conscious that you've done 8 acquisitions in the last 10 years. Is it fair to say that irrespective of your ability to conclude more acquisitions in the future, given there is always some amount of deal risk, you would continue to pursue a very robust organic strategy to deliver scale? That is one question. And the second question was around acquisitions. Just some thought process.
Is it just me or will we lose Namit? Hello?
Yes, sir. I'm sorry. It seems we have lost line of the current participant, sir. Just a moment. Yeah, sorry, Namit, can you please repeat your question? You're unmuted now.
Okay. So I guess I was not unmuted so far. So anyway, let me repeat my question. So my first question.
Namit, we heard you. Just that we missed you in the last minute.
Okay. So maybe I'll just turn it over to the management. Yeah. Maybe you can respond to.
We got your. Yeah, we got your first question on supercharging scale. Your next question was on acquisitions. If you could repeat that, then I'll answer both together.
Sure. Thank you very much. Thank you. So my second question was, I am cognizant you've done 8 acquisitions in the last 10 years. Going forward, since you may be pursuing larger acquisitions, your thought process in terms of criteria and some thought process around de-risking, maybe through earnouts or, trying to retain management teams for 3 to 5 years, some color around that. Because some of the larger Indian companies have struggled with larger acquisitions. So just some thought process to de-risk that. Thank you.
Thanks, Amit. Great question. So on supercharging scale, like I've shared before, the goal is to get to 500 crores to 900 crores organically, and then 900 to 1500 crores, the gap of 600 coming inorganically. Our expectation is that, so the 500 to 900 is roughly about 12-13% type of organic growth. Our expectation is that the content business will continue to grow at 10-12%. The platform business will grow at 10-15%, and then the e-learning business will grow at in the range of 15 to 25%, and then within e-learning, the Imagine business will potentially grow at a higher clip, potentially 20 to 30%, because there's a small base effect. And there's a full-blown strategy that you can read about in our annual report of how we're pursuing this organic growth, and we're starting to see already results from that, as both Sukhwant and talked about the content side, Jums talked about the e-learning side, and I summarized for the platform side. So we're already seeing early signs of that in FY23 as well as Q1 of FY24. Coming to acquisitions, as you rightly pointed out, we are looking at acquisitions where there is at least 15% EBITDA margin at the minimum. The company should have been growing at a CAGR of 10% minimum over a sustainable 3-year period, and also have a strong outlook going forward. And as you rightly said, when you look at businesses like this, typically you have a competent management team, and our role then changes from being an operator to being someone that supports that management team. So that's a big change on the execution side of the strategy. We've done this at a small scale last year with EI Design, which is giving us confidence. So one of the things that we're doing, which is unique in our approach to acquisitions, is for us, cultural fit has become a very significant variable as we're selecting companies beyond the financial parameters that I described. So cultural fit and just trying to figure out if the alignment between us and the acquired management team is there, and can we actually get along and work together. That's something that we've started to really study, and also for the very first time we have our HR teams also as part of the deal process. And yes, we are looking in most cases we are looking either at stage buyouts where we step up our shareholding over a period of time, or we're also looking at an earnout approach as well, depending on the objectives of the founders. And so those two are the dominant use case for us when looking at these type of deals. And then finally there are a couple where we're looking at a combination of both earnout as well as stage buyout. But mostly it's either of these two things. And the goal, of course, is for us to extend the management team going forward, and for us to kind of play more of a support advisory role rather than an operating role. So yes, that's a big change in our strategy.
Got it. This is most helpful, and I really appreciate your very candid and detailed perspective, and all the best to the entire team. Thank you.
Thank you.
Naveen.
The next question is from the line of Arun Marothi from Shubhlab Research. Please go ahead.
Am I audible?
Yes, Arun. Can you please speak up a bit and go ahead?
Yeah. Thanks for the opportunity, sir. Sir, my question is on the revenue part, that in AGM also you said that we are growing by 30% yearly. On it, it will be quite helpful.
Yeah, sure. So last year, I'll speak the numbers, and maybe James can give more color on what's happening behind the scenes. So last year, I think if I get it, I'm going to share some ballpark numbers. Our Imagine numbers, were in the range of 12-13 crores. Our expectation in FY24 is that, at the minimum, we'll grow to 30%, possibly even more. And what's giving us that confidence is that we're winning new projects. We are also, doing better with some of our existing customers on building out existing centers. But James, if you'd like to just back me up here and weigh in on and give some more color on the Imagine business.
Sure. So the big difference in the Imagine business versus our existing e-learning business is that in the e-learning business we are focusing purely on the training and the learning fraternity, whereas the Imagine business is catering to the marketing fraternity, which means the budgets are much larger, the value sizes are much larger. In some sense, even in a small bad year, the marketing budgets are fairly large. So what the difference is that we're able to augment a fair amount of the same staff that we currently have and cater to a new line of business that's much larger in scale.
Okay, sir. And one question on the employee side, that despite having a decrease in the number of employees, our employee cost has increased a little bit. So what is the reason behind that, sir?
I'm sorry, could you repeat that?
That despite the employee numbers has gone down in this quarter, our employee cost has increased a little bit. So what was the reason for that increase, sir?
So Sunit, you want to talk about that? Is it ESOPs or?
So, will you quantify the impact of ESOP on it because it is one time now?
Yes, there are two things which have impacted. One is that in the last financial, the same quarter, EI Design was there for a month, and now it is there for the 3 months. So basically, that's 2-month impact has also come. The second is there is an impact of ESOP charges which are for the first time in this quarter, and that amount is closer to 32 lakhs. And the third is the normal increments.
Okay. That's it from my side. Thank you, sir. Okay.
Thank you. Next question is from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yeah, it's audible.
Rahul, your voice is muffled. Can I request you to use the handset mode, please?
Hello, is this any better?
Yes, please go ahead.
Yes, sorry for that. So, firstly, hope you see this, the seasonality of the business now, Rahul, the way some of this business have settled and you have certain growth in your mind. So, what are the put and takes in the different quarter for different business unit, and what is the right seasonality that you have in your mind?
Yeah, I think Q3 and Q4 tend to be our biggest quarters. It's a combination of a lot of our customers closing out their respective financial year. Some of them close it out December 31st, some of them close it out March 31st. So as a result, there's a push at the end. So typically, we see Q3 and Q4 tend to be our biggest, quarters. Historically, Q1 has been our softest. So we'll have to see how that plays out. But definitely Q3 and Q4 tend to be our strongest quarters.
So this Q1, are you slightly positively surprised by this performance in content platform?
I'm happy. I'm not surprised. I'm happy with the performance. Not surprised. We expected this. We also had a weak Q1 last year, which was uncharacteristic as well. So there's that aspect as well.
Sure. And on the e-learning side, same pattern or?
Yeah, I think for the pattern is pretty similar for both content and e-learning. Platform is slightly different. Platform tends to be more uniform because a large chunk of the platform business is recurring. So content and e-learning, Q3, Q4 biggest, Q1, Q2 similar, possibly Q1 softer. And then on the platform side, fairly uniform. Having Q1 of this year, we had some interesting project revenue, which is outside of recurring revenue. So yeah, I would say Q3, Q4 content, e-learning super strong, and platform would be more kind of balanced throughout the year.
Sure. And, you just mentioned that there was an increment kind of an impact. So is this the annual cycle that we have gone through in this quarter, or there is some more to come during the year in different geography or something?
No, all our increments are done in the same cycle. So it's done with. So it was Q1 is our increment cycle, and then of course we also had the first time we've introduced an ESOP program. So it's a combination of increments and ESOPs.
Right. And if you could say that how many people have covered under this program as of now?
The ESOP program?
Yes.
I think it's 50, 55. I'm not sure the exact number. Maybe Sunit, you can share the exact number. How many people have been covered?
Mm-hmm. Yeah, as of now, 60 people have been covered.
Understood. And last question from my side is related to the comment and explanation that you gave on your acquisition strategy. So is it safer to assume that you, or maybe you could clarify this, would you be open to do a 51% stake kind of a transaction, or you would only go for the one where you would have a clear path to 100%, because now you want that operator, more support model rather than an operator model?
Yeah, so we definitely want majority control. The conversations that we've been having are 60, 65, 75 type of percent, not 51. But yes, definitely trying to get majority control in the beginning. Of course, I'm only sharing with you based on the conversations we've had so far and having today. That could change in the next 6-12 months. But based on the visibility as of today, we're looking at majority control. In some conversations, it's 65. In some conversations, it's 75.
Right. And just clarification on the QIP comment you mentioned. Are you trying to say that for now you are not pursuing it? Only if you have those size of transactions available to you, then only you may go ahead with the plan.
Yeah, again, based on the visibility today, the thinking as well as the approach is that we feel comfortable that the next two we will probably just fund from internal accruals. After which, of course, the internal accruals will also go up because these are EPS accretive acquisitions and cash flow positive acquisitions. So the overall cash generated from the business will also go up post these couple of acquisitions. So the next goal will be try to fund it from accruals, maybe take on some debt, 130 crores at the most, and only if all those funds are insufficient and we've got some really compelling case for executing Vision 2027 in one shot, for example, only then we would proceed with something like a QIP.
Got it.
And the background of why we've done this is it's you need a right to sit at the table. And with 200, there are certain type of transactions where you cannot sit at the table till you can prove that you have a certain amount of financial strength.
Sure. Understand that. Thank you so much and best of luck for the time.
Thank you. The next question is from the line of Pulkit Chawla from Emkay Global. Please go ahead.
Hi, thanks for the opportunity. So Rahul, first on the platform, I think good to see double-digit growth finally coming in. Just wanted to understand the near-term future for this segment. How are you planning to grow? And if you could throw some color around the 3 products that you mentioned as a part of your initial remarks. Second, some things about your e-learning segment. Are you seeing any short-term pain given that the macroeconomic environment is not the strongest? And just a small clarification, e-learning segment margins are a tad bit weaker this quarter. So some clarification on that. Thank you.
Sorry, I'm just noting down all the points. I don't forget something. So overall platform business, I was sharing, we expect 10-15% growth towards Vision 2027 by FY28 that is charted out. Near term, we expect it to be more closer to 10%. As we head closer towards FY28, it'll probably be closer to 15%. But broadly, that's what we're expecting in the short term. In terms of new product launches, we are not expecting any revenue from these product launches this year because they're going to be fresh launches. Even if we sign up customers, by the time we set them up, we would have probably been in the next financial year. What are these 3 launches? The first one is ThinkWeb, which is basically a next generation version of our Think platform, which manages the order to cash cycle for our subscription customers that have subscription revenue. So this is a next generation platform that's entirely cloud based and web based, which is unprecedented in this industry. So we're expecting to launch that in the next quarter and rather this quarter now. And we do already have existing customers who are planning to migrate to this next generation platform. The second one is a product that basically unifies our Ampere workflow product, which is focused on production, and our Benchpress product, which is focused on manuscript submission and peer review. So it's unifying both products in a new use case where we're learning that on the publishing side, the lines between editorial and production are blurring. So we're creating a unified platform that helps in the execution of that type of thinking. So basically, it takes a manuscript from submission and review to all the way to the platform. So, and when I say unifying, I don't mean we're taking two products and integrating them. We're actually creating a brand new product with fresh modular architecture based on microservices. So it's a brand new product, and the goal for that one is to launch it at Frankfurt Book Fair, in October, and finally launching a new SaaS products in the last quarter of this year, which is focused on the author side. So it basically helps manage the author payments as we're learning that there's a new revenue stream that's getting created through the author community. So it provides basically it's an author-centric platform that allows an author to self-publish, but also provides support services to the author, such as editorial, layout, those kind of services. So it's an author-centric platform. So those are three planned for this year. Your next question was on e-learning. We are not seeing any, and potentially maybe because we are much smaller and also more diversified than some of our competitors, we're not seeing any slowdown. In fact, we're growing, as you can see from the numbers. In terms of, and also as Jums mentioned, Maginu is part of this business segment, and that's actually growing even faster. In terms of margins on the e-learning side, good observation. As we are basically setting ourselves up for an expansion this year. So we are sitting on some excess capacity in Q1 because we're expecting some disproportionate growth in the second half of the year. Because of which Q1 margins are soft, but we anticipate as the year closes out at an annual level, our margins will be where they need to be. So we are basically sitting on excess capacity because we have orders that are unlocked in the second half of the year.
Thanks. That's very helpful. That's it from me. Thank you.
Thank you.
Thank you. The next question is from the line of Akasha Deo from Vivo Commercial Limited. Please go ahead.
Yeah. Hello. Hi. Congratulations. It was a good quarter this year. I just wanted to know the platform's growth that you are looking at, roughly 10% for the near term. Are you expecting this to come from new projects or from the recurring revenue?
Yeah, I think short term we're getting it mostly from projects, and the reason for that is that. Let me explain maybe the nuance a little bit. So what's happening is that we are basically doing two things. One, we are upgrading many of our customers into the next generation of technologies. As a result, as we migrate them into the next generation, there's a cost and a project associated with it. Now, obviously, because it is a next generation technology, they also end up paying more over a period of time. So in the short term, we're getting this bump because we're migrating them. So that's the first aspect. And the second aspect is we've onboarded new customers, and currently we're in the setup phase. In the short term, we'll see more project revenue, which is associated with setup. But once the setup is complete and they go live, we'll see a lift in the recurring revenue as well. So the short answer is that short term it's more project based, but from next year onward it'll probably be more recurring and less project based. So it's a sort of a short term anomaly that's happening because we're scaling up.
So this is due to Highwire or your existing, the pre-Highwire?
All our SaaS products are now marketed under the umbrella brand called Highwire. So this includes everything from what we got from Macmillan back in 2012 that we've improved upon, MacPlus, Think, and what we got from the Highwire product suite. So it's all of our products are now marketed under one brand, and we have the same team that's working across this as one business.
So Highwire, would you say, as the 5-year plan you were at for that acquisition, and it's currently at the 3rd year, would you say it's going according to plan as of now, or is it better?
I would say it was going as per plan. We're very happy. It's better now, but I think we've gotten a bit lucky. It's more luck than anything else, and we've gotten a few lucky breaks. We won a few RFPs. We had customers who were totally unwilling to go to the next generation, and suddenly, out of the blue, they decided to go to the next generation. So I would say going as per plan and even better because of a couple of lucky breaks.
That's great. That's great. And a follow-up for acquisition was the two acquisitions that you are looking at. Can you give a range of the deal size or the probable deal size and which vertical they would be for?
Yeah, so we're pretty much looking mostly at e-learning and platform. In terms of, it's difficult to give you a forward-looking estimate like that, but like I've shared previously, we are no longer looking at distressed acquisitions. So we're looking at a multiple of EBITDA now. This could range, anything from 4 to 8, depending on what is the level of growth as a track record, but also what is the growth potential of the business. So it's a very broad range. In terms of, size, I think we're trying to look at anything that's north of $10 million in revenue at the minimum. So and at least 15% EBITDA margin. So you can do your math.
Okay, that's great. That's great. So the content growth was great this quarter, especially. Do you expect this to continue?
Yes, I think content is now, so last year, as Sukhwant was describing in his opening remarks, last year we had this unique. So our content business basically has 3 major buckets. One bucket is our scholarly business, so which is focused on scientific and research publishing. The second bucket is education, which is focused more on the education universities, publishers, and so on. And the third one is more, some of our smaller business units that perform a certain function, like our digital solutions business, which basically is a conversion business. So those are much smaller businesses. What was happening last year was that out of these 3, only the scholarly business was growing. So it was giving us a nice, lift, but everything was not performing. What's different this year is that the 2 largest, which are like 95% of the revenue of content, scholarly plus education, they both are growing. So Q1, scholarly grew at 15 and education grew at 11.5. And as a result, we're seeing this big lift, and we expect it to continue through the course of the year. And as I had shared in a previous question, our strongest quarter for content quarters are normally Q3 and Q4. So we haven't seen the best just yet for this year.
Okay, great. That's great. And last question from my side: are you seeing any order book for experience centers? Any new orders?
Eminent. We'll definitely share with you.
Oh,
We've won some orders in Q1. But yes, eminent, and obviously if it's something that's material, we will share with you.
Okay. Thank you so much. That was from my side.
Thank you.
Thank you. The next question is on the line of Mohammed Hassan from Fairdeal. Please go ahead.
Hello.
Yes, please go ahead.
Am I audible?
Yes, you're audible.
Okay. So thank you for the opportunity. I just had the question regarding the margin side. Since for the past few quarters, we have seen a very good margin past the 40% plus levels. So do we expect the same, or can you throw some light on it?
Yeah, I think with content, we want the margins to be in the 40s. Historically, we've even been in the mid 40s. So and a large part of that is now going to come from revenue growth. So as long as the revenue keeps growing, margins will continue to expand, and stable level for content is the 40 to 45% range. With respect to platforms, I think we've hit a very good level. We'd like to sustain it from here. So again, 40 to 45%. With e-learning, I think, like I was explaining earlier, we slipped a little bit in Q1 of FY24, and the reason for that was that we are ramping up towards a significant scale up for the second half of the year, and sometimes you have to invest in the ramp up, and that's what we're doing. So overall, I think this year e-learning, our goal will be to sustain the 25-27% type of margin, and hopefully in the longer term break the 30% barrier on the e-learning side as well. So overall, I think 35% is something that we'd be happy with at a consolidated level. Now that 35 could be 37, that's something that we'll definitely flex and stretch towards.
Thank you. Thank you so much.
Thank you. A reminder to our participants, please press star and one to ask a question. The next question is from the line of Rishikesh Kale from as an individual investor. Please go ahead.
Yes. So last year you had given a target of 100 crore PAT. Would you be in a position to give a similar guidance this year?
Thank you for holding us responsible, Rishikesh. So if you remember, last year I had given that number in Q2, and I promise you I will give you something in Q2.
Okay. Sure. Thank you.
Thank you. The next question is from the line of Mahesh as an individual investor. Please go ahead.
Hi, Rahul. Sometime back, you had expressed desire to get into managed services within e-learning. What's the progress on that front?
Yeah, so thank you for the question. Yes, I think from our perspective, that's definitely as we climb up on the e-learning value chain, that's definitely a goal for us. We are pursuing that through an acquisitive strategy because it's a new capability area. We've had some conversations with strategic customers of trying to build it out organically, but it seems that it is most likely something that we will have to develop through an acquisition, and that's something we're actively working on.
Okay. My second question is, have you managed to increase wallet share of your top 5 or top 10 e-learning customers after your acquisition of EI Design?
Yes, so a couple of things. I think one is within the top 10, we now have 2 new logos that we didn't have before EI, and it was basically because of the combination. Even for EI, they were not top 10. So as a result of the synergies that we've unlocked, we've been able to land a couple of very large customers that were smaller earlier. So we have 2 new customers featuring in our e-learning top 10. And the second, because of, as Jum described in his opening remarks, we're getting a lot more reliable. We were always very creative in the type of work that we do. We've always known to be different in our approach, different in the experiences that we created. But I think we've become, after the acquisition of EI Design, we've become more reliable in our delivery and our quality. And as a result of being at the intersection of reliability and creativity, we are gaining more wallet share with our top 10 accounts. And yes, we're seeing a lot of traction with that customer base.
Rahul, can you give some more information on the 2 new logos, name, geography, something more?
Names I will not be able to give. One is just more out of respect for the customer, but also for competitive reasons. In terms of geography, interestingly, both customers are customers from India.
Okay. Thank you, Rahul. That's it for me.
Thank you.
Thank you. Any participants who wish to ask a question at this time, they may please press star and 1. The next question is from the line of Jyoti Singh from Arihant Capital Markets. Please go ahead.
Thank you for the opportunity.
Your voice is breaking. We are unable to hear you clearly.
Yeah. So now it's better?
Yes, it's better, but still we are losing your audio in between. Okay, please carry on. We'll let you know if the audio breaks.
Yeah. Thank you for the opportunity and congratulations on the good set of numbers. So, sir, my question is more on the margin front. So, we did a good margin in this quarter. So, what are expectations going forward?
Yeah, as I was sharing previously, from here on, margin expansion is largely a function of revenue growth. at a consolidated level, we'll be happy at 35%. We want content to be between 40-45, platform to be between 40-45. This year, e-learning to be at 25-27, and hopefully break the 30% barrier, at some point. Also, it's important to note that Q3 and Q4 tend to be our strongest quarters in terms of revenue. So, like I pointed out, margins expand as revenue grows.
Okay. And sir, this platform business that we have seen consolidation, and we are expecting 10% in near term and 10 to 15% by FY28. So which other segment we are seeing more traction?
Yeah, so our fastest growing segment, as Jones pointed out in his opening remarks, continues to be e-learning in terms of growth, revenue growth. E-learning is definitely our fastest growing segment, and there we work mostly with large corporates.
Okay, thank you, sir. It's a recent development more on the generative AI front. So how we are benefiting from that?
Yeah, I think so. Again, we in terms of, like I was explaining in my opening remarks, there's a lot of activity that we are pursuing. As an organization, we set up a dedicated unit called MPS Labs, which is headquartered out of Bangalore and has over 100 people that have the relevant expertise and are producing projects that are either established projects where we've been able to execute them for a decent customer base, emerging where we've done it for a small set of the customer base, and pilot where we are collaborating with customers but we haven't gone live in production. So we are viewing it as an opportunity to yet again consolidate the supply chain on behalf of our customer base. As we saw in the pandemic and coming out of the pandemic, there was a significant consolidation that took place in the supply chain. And every round of shock that the supply chain gets, the market consolidates, and scaled players like MPS tend to benefit. So we are seeing it as a positive. We are investing in a meaningful way. We are adapting as well. So it's more a medium-term type of situation where we are hoping to have the market consolidate and gain more market share as a result. More near term, we are mostly investing to future-proof ourselves and also to future-proof our customers.
Okay, thank you, sir.
Thank you. We'll take the follow-up question from the line of Mahesh as an individual investor. Please go ahead.
Hi, Rahul again. Rahul, how many inorganic opportunities have you let go in the last 12 months that you looked at?
About 6. Again, I'm giving you a ballpark estimate, don't hold me to it, but around 6.
Any qualitative reasons?
Yeah, I think a few of them, the numbers we didn't have confidence around the future growth potential of the business. A couple of them, were more B2C focused, and we were very sensitive to not breaking this momentum. So we are conservative on the type of acquisitions that we do. So we're not going to do anything that is totally dissimilar from us. We want to do things that are closer to our business model. So a couple of them were more B2C focused, and a couple of them we didn't see a cultural fit, we didn't see a management fit. We felt that we would not be able to work with the founder team. So it's a combination of a variety of reasons, but I would say about 6 where we walked away.
Okay. My last question: what is your own assessment of the existing run rate of MPS e-learning against the context of the total addressable market?
Yeah, I think we are a very small fish in this massive ocean. E-learning is valued based on, depending on what report you look at, is upwards of $200 billion in total addressable market. So we are very, very small, fish. The largest player is in the $300 to $400 million range. We are nowhere close to that. So, having said that, let's call it a $300 billion market. In a $300 billion market, if your largest player is 400 million, that shows you how fragmented the market is and how ripe it is for consolidation. So we are viewing it as a positive and also as an opportunity to go ahead and play the role of a consolidator. To sum up that comment, we feel managed services is potentially going to be the play here, where there'll be a few vendors that will, acquire a lot of near-shore expertise that will allow them to truly execute and perform managed services at a global level. So that's the forward-looking play.
Thank you very much, Rahul. That's it from my end.
Thank you. Ladies and gentlemen, that will be our last question for today. I now hand the conference back to Mr. Rahul Arora for closing remarks. Thank you, and over to you, sir.
Thank you, everyone. Thank you for your active participation at our Q1 FY24 earnings call. We appreciate, as always, your thoughtful questions. Your unique outside-in perspective helps us to learn and improve. I want to express my gratitude to each of you for all your deep questions, also for some of those questions where you held us accountable. So thank you for that. Our journey together has been remarkable, and we see a tremendous opportunity here for MPS to supercharge scale, and we look forward to your continued support, feedback, and partnership mindset. Thank you so much.
Thank you very much. Ladies and gentlemen, on behalf of MPS Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.